Hello, everyone. Thank you for joining Axios. We have a very exciting guest for you today.
Good morning, Courtney. I'm going to put you center stage.
Center stage, okay. Wow.
Thank you very much, and thank you to Lightspeed for this incredible week of events. Such a great Davos. We're very appreciative to you in this incredible space. Thank my colleagues at Axios Events who have put on an incredible week. And Brian Moynihan, Chairman and CEO of Bank of America. Brian's celebrating 15 years as CEO, an incredible track record. Banking and the bank were in a very different place 15 years ago, so we're going to talk to him a little bit about that. Brian and Bank of America have been a friend of Axios from day zero. We just turned 8, and Brian and his colleagues at the bank believed in us before we even had a name. So we're grateful to you for supporting our journalism over the years. Our friend Larry DeRita, our friend Jessica Oppenheim are here, some other friends from the bank, so I wanted to thank all of you. Brian, Axios is big on leadership, like how you can get ahead, how the very best can do even better. Before Courtney plunges in, I'd love if you have one thought about how someone can take a bank that, take an organization that was where you were coming out of the troubles coming into 2000. And last week, Brian celebrated his anniversary by announcing that Bank of America had 2024 revenues of $27 billion and revenues had gone back over $100 billion.
So I think I was thinking this, I just walked out of the room where I remember walking out of in 2010, January here, and there was 150 reporters waiting for us to walk out of a meeting as to what was going to be decided about banking regulation, as if the people in that room had any right to make a decision. And it was the regulators and stuff. They thought that we were going to come out and announce Dodd-Frank, and you're like, so it was an interesting time because the world focused on a set of institutions globally. And the way that you had to when I stepped in, I came through a very difficult process in the fourth quarter of 2009 that was all over the TV, and basically had to make a simple solution. We had a wonderful set of companies and franchises and core business, and we had a problem. And the problem was actually changed from, in the first 3 years, people would have said it was a Merrill problem and a capital markets problem, then it became a mortgage problem, and then it became a credit card problem, but it was a problem which was the aftermath of the credit crisis in the United States. So we divided and conquered. The simple question of leadership is you can't take 285,000 people and try to have them figure out the bad side of what's going on. You got to get somebody to go out there and serve the clients and customers and do it. So we divide and conquer, put a team against A, a team against B, and off we went. And then the second part was to remember why you were there. So the idea of saying, people talk about profits and purpose and focus and the different ways you think about it. If you can't remember why you're there and you're not making a lot of money because the world's going under, you're going to kind of depress yourself. So you had to keep people focused on what do. We help clients live their lives. People, companies, institutional investors, go out and focus on them. Go out and get your energy off of them as opposed to off of regulators and congressional hearings and things like that. And so that was the beginning of us really being declarative of profits and purpose, the genius of the and, not the or.
Great advice for any industry. My colleague Courtenay Brown, we were lucky enough to lure her away from CNBC. She's been a big part of the Axios success. She's co-author of our midday newsletter, Macro. Courtenay, we appreciate your expertise. Take the ball.
No, thank you for including me in this. This is great. And Brian, it's good to see you. So at Axios, we start with the news, right? So Trump will speak to the World Economic Forum later today. We learned that you're going to be one of the few people who get to ask him a question. Give us a sneak peek of what you're going to ask him. I have to try.
Well, let's crowdsource it, right? I think that, look, for the last 72 hours, I've gotten a lot of questions about what's happening in America, what could happen. And so I'm going to take the opportunity to ask him about those questions, which is really how do tariffs factor into his visions of growth? How does an immigration policy factor in what our business customers tell us there's still labor shortages in certain areas? And try to get him to discuss how he's balancing that, because he will judge himself, I think, by his growth. By his growth in the economy and the value of the stock market are two major things in solving some of the geopolitical context. And I think, so I think it'd be comforting, so to speak, if people could sort of understand how he's going to make those decisions that are trade-offs between one thing and another thing in real time. So if we get to that point where we get to ask a question, it'll be something on that.
What if someone asks that question? What's your backup question?
I think that it ought to be a little more. There's only 3 of us asking questions, so hopefully we won't screw it up.
Might be a little collusion there. So,
If
Brian,
if there isn't, I got to come up with another one. So keep thinking and send me something.
A little bit like being a reporter at a press conference, scare another reporter going to take your question. What's your relationship like with Trump?
Look, it's interesting. In the first part of his first term, I was the head of the thing called the International Business Council here at the WEF, and the president came, and we walked through 150 to 175 CEOs and had a session where we walked around, and he was introducing himself to a lot of these people for the first time because I think it was 18, so it was very early on, and he wants to get things done, and I think what you saw reflected in the American election is a decision about lower regulation, lower centralized government, lower after you, and an ability to focus on, and this is international setting, so this, when you're Bank of America, this sounds doubly sort of narrow-minded, but focus on America and its role, and I think that's good, and everything I see about him, working with him actually in the early stages of COVID in 2020 and other things has always been, how do I improve the country? But by the way, that's every president. And we've worked with every president since George Washington in our company, so it's not like this is a new capability.
Yeah, this thing of getting things done, like as we talk to his inner circle, they're very confident, and what you hear a lot is the president no longer listens. When people tell him, you can't do that, that's not how it's done, usually a senator, he says, like he just doesn't listen. Brian, over 15 years, I've been privileged to have lots of conversations with you. I know that you're both an optimist and a realist. What does the optimist side of your brain tell you about the new administration? What does the realist tell you?
I think the optimism is when you talk to our customers and clients, over the last 12 months, the concerns about inflation were coming down. The concerns about interest rate increases. It was a 5 or 10-fold increase in the base rate of which most commercial borrowers borrow off of. That's not small. It have given way to an enthusiasm, but that was overwhelmed in the last 6 months by the regulatory burden. If you talk to our larger customers, you couldn't get deals done. You talk to our mid-sized customers, a new rule regulation was coming out every day, and they don't have the staff that we do to figure it all out and apply it. Whether it's on labor practices, whether it's on disclosure to larger companies, whether it's on labeling practices for a good or whatever it was. So I think all that people feel very relieved about, and that's the optimism, because the question is how much does that uncork in the United States, and how much was being held back as rates have come down a bit. It'll still stay higher than people are used to as growth has slowed down actually, but still stronger than we all thought it would be. How much can regulation help? And it's so much that our research team, and Candace Browning-Platt, we have a wonderful research team, basically thinks that will outweigh tariffs as long as they're in the 10-15% range. Just that lower regulatory burden will result in higher profit margins, will allow us to manage the tariff burden differently.
So that's interesting. So you're essentially saying that there is all this economic concern about how tariffs will blow back on the U.S. economy and to the global economy to some extent. But as far as the U.S. is concerned, you think that lower regulation, lower corporate taxes might offset whatever weakness that comes on that front.
So one of the wonderful things about running Bank of America, I have a team of several thousand people who study this and do it. So that's what they think, and it makes sense to me. But they're much more skilled at the analysis. But it's really in moderation. I mean, we absorbed, if you go back and think about it, we absorbed the tariffs that were put on in the first administration, and they never came off in the state 10 years later, and we're talking about being outsized growth relative to trend and relative to the rest of the world. So obviously those tariffs didn't hold it back. It takes a while to get through the system and adjust and everything. But I think, I think people have to be careful about saying tariffs are bad because it's against free trade, because that is one point of view, but on the other hand, what are you trying to accomplish is really the question, and that will be the plus or minus. So they get very high, obviously has a bigger impact on the economy.
That's an interesting point to make at a conference that I think was founded on this premise of globalization.
Yeah.
But as Davos comes to an end, I'm curious, you're here, you're taking lots of meetings, you're talking to a lot of people. What's different this year, and what's the same?
I think a couple things. I think one, one of your colleagues asked me my one word to explain. I said enthusiasm. They when you listen to the community, there's enthusiasm that there's a push in Europe, competitiveness and growth. There's a push in the United States for growth. There's a push in India's been on a long-term push for growth. So the idea of growth, building a bigger pie, then worrying about how to mete it out equitably and how to accomplish the purposes, that's an enthusiasm I see. In prior years, it's born by how we regulate the outcomes, and now it's how do we build the economic engine that can pay for the outcomes, and that enthusiasm is different.
I want to talk about your time at the bank, your 15 years at the bank. Let's pose a hypothetical. You can go back to 2010 Brian, and you can give him one piece of advice before he takes the helm of Bank of America. What do you tell him?
I think the piece of advice that I stumbled into that I wish you would have come out with. Look, lots of people say, well, the first thing is get your team together. I had got a team together, and they're a terrific team. And the first thing is, this and that. A lot of people have an idea. But the real question is, what you really said is, in retrospect, as opposed to that question, is can you balance pace, doability, not losing people, and keeping people to the spirit of the place? And did you get that right? And we always have to ask ourselves, did we go fast enough but slow enough? Did we go fast enough to make it all work but slow enough that we got it done well? And things. So that pace and continuity done. And I think, but I in the end of the day, I'm not sure there's one piece of advice I'd change, but it's would you have the wisdom you had 10 years ago to make the decisions differently? And of course you had better wisdom. But on the other hand, would you have the sort of the urgency that you had then? Because it was a crisis, we had a tremendous urgency. And so we were able to skip steps, and that was good too. So I think that idea of pace and how do you make change happen across 285,000 people, 60 million customers, et cetera, is one that I always question, how do you keep that right all the time? Because everybody says, startups should grow fast and all that stuff. Like, we had 285,000 people. We have 213,000 people. That's a heck of a change in the company across 15 years. Yeah. And yet you had to judge how you were going to do that.
Right. I think it's only J.P. Morgan's Jamie Dimon among the big bank CEOs who's been at the helm of his company longer than you have. So I want to ask a question on behalf of our editor-in-chief who's in the crowd here. Is there a big bank CEO group chat? And did they wish you all happy 15 years?
We get together periodically.
But no group chat?
And not a group chat. That would be a dangerous thing. But we do get together periodically and recognize it's been interesting. It's not only banks, but meeting with public figures, you start to see how many have come and gone. And that's one thing that business leaders have to remember is whether they're in a position or not, the CEO of this company will be here. And it's literally true. The oldest part of a company was here when George Washington was president. And so you have to think of that arc and how you leave the woodpile bigger and all the stuff we talk about. But you're here for a moment, but that moment actually extends most political lengths by a lot. Just the average CEO tenure is about 1.5 times a presidential term. So you're going to have a longer term time frame. And the question is, how do you get the political and piece to come along and help the private sector drive the change they need to drive? Because you're going to be here and they're not, and that puts you on different time modes.
So did Jamie send you an edible arrangements for your 15 years or no?
I don't remember getting that, but it could. When
will you know it's time for new leadership at Bank of America?
Well, you have to be enthusiastic every day, and you have to be healthy, and you have to keep going. You have to be able to challenge yourself with new ideas. And so, the issue is that's not my decision. That's a board decision. The challenge is how do you make sure that if I got hit by the proverbial truck out here on the road or something like that, you're ready to go at any time. And we work at that all the time. But the reality is it's 213,000 people. It's all this stuff. We have 20,000 managers in the company. And if you think they wait around for me to say do X or do Y, we would do nothing. And so there's a tremendous group of talent in that company. And so I think I've always said, you know when to go, when not get up every morning and say, here we go, let's have a day, no matter what crap's going on. And that has never happened to me. And to see and anytime you feel a little down, you just go into one of the branches and those teammates and what they do and how they do it and how enthusiastic they are. You just sort of say, well, that restores your batteries, and off you go.
Brian, zooming out from you and from Bank of America, I know that in addition to the strength of the economy, something that you're passionate about is the future of banking. I wonder if you could look at the industry, pick a horizon, 5 years, 10 years. How do you see your great industry changing?
Well, I think there are 4 or 5 trends that affect all business, including the bank industry. One is obviously the use of digital work. And so AI is the current rendition, but this has been going on for years. The second is the computational power to make that relevant. And the third is the computational and the network capacity to distribute it. And the other thing is the customer's willingness to use it. And you add that all together, and in the end of the day, it is we had 1.5 billion digital logins last quarter. And when that phone was invented, we were the first app that was available on it outside Apple apps, because we'd only developed a web-based app, an internet-based app. Didn't even call it that then, but that's what we did. So when Steve held it up, the Bank of America app there, and then took off. So that change that went on continues. It just keeps changing for us. So as you look ahead, the Erica, which is our product, which is an AI virtual assistant, we just didn't call it when we developed it 10 years ago and got a natural language processing engine to drive it from Stanford, because one didn't exist. Had 20 million customers use it. So these impacts will be huge. And so that dynamic will go on. But what won't change is the need to understand customer needs, whether it's a human, whether it's a person, any of you, whether it's companies you work for, or whether if you're an investor, it's the investments you make, to understand what the client wants. So the question is, how do you drive all this change and all this $4 billion you spend on technology every year? We have a lot less branches, but we deploy branches every year into new places and all this stuff. How do you make that all work? But you can't forget, it's real customers. And so all the science projects in the world mean nothing if the customer doesn't understand what you're doing. So everybody will tell me, nobody in this room will say they ever use cash. By tomorrow this time, $200 million will go out of our ATMs in cash. So somebody's using it. Everybody says they don't write checks. 100 million checks got written by our customers last quarter. So the idea that these absolutisms are never true, because the customer wants to do everything their way. So I think all that, it's really technology, the application of technology, and acceptance by the consumer of technology, is really what will keep changing. Those technologies will change. Our job is to be just at the right place with the customer technology interface and make it work.
Who are these people writing checks? I always think about that.
Now, and somebody that's younger than Mike and I, like you are, will assume it's all those old people. It's not.
I'm here in Davos too, so I get to talk to a lot of people, including like you, and I get to hear a lot of new ideas. One thing I heard yesterday, I would love to run by you. Someone raised the idea of there being a boom economy and a bust economy happening at the same time. On the boom side, stock market up and up and up. You have the Trump and Melania meme coin worth billions of dollars. But on the bust side, you have credit card defaults picking up. You have a significant share of student loan borrowers who are not current on their payments since the moratorium is ending. So do you see that in your business?
So this is a matter of perspective. The credit card delinquency rate has moved up. It's the same as it was in 2019. 2019 was a 50-year low in credit costs for our company. So we're normalizing off this strange period of the pandemic worldwide that has lots of things. It had huge fiscal deficits taken on, huge stimulus given, we took a 30% downdraft in a single quarter in the economy, whatever the math was for that one quarter, and spackled it over and then did more. So you have to let this play out for like 2 or 3 more years before you can really figure out whether there's been a fundamental change. But if you look at, people say credit card debt's up nominally. The economy is 30% bigger nominally than it was 2019. Of course, it's back. As a percentage in their ability to carry debt, we don't see it. There are segments always of customers who have difficulty paying and stuff due to the fact that at 4.1% unemployment times 150 million workers, to make it simple, that's still a lot of people are unemployed at any given moment. So you start to remember that and you can't be unmindful that there are people in stress at all times. That number is actually very low in a long-term sense. much like the interest rate environment, is actually more normal than the last 15 years. That is very hard for people to understand who've only been in the workforce since 2004 or 5 to now. But this is normal. It's normal to have a 3 to 4% Fed funds rate. It's normal to have a 4.5% tenure rate. That is normal. What is abnormal is to have a 0% or a 50 basis point. That's very unusual. And so I think getting people used to that, the credit card delinquency rate before the financial crisis would have been 5.5, and everybody was thought, or charge-off rate was 5.5, and everybody thought it was great. The unemployment rate was 5. It's something we said was full employment. We now say 4.1. We're scared going to 4.3. So part of it's just perspective of where people come from. But this is where you have to be careful. In the aggregate, the consumer in America is doing well. There are always pockets that are struggling, and our job as a company is to work with people struggle in our company and make sure they're doing good, that we can help them back to their financial stability.
You have been seeing consumer deposits going down, I believe, but this most recent quarter you said perhaps there's been a floor underneath consumer deposits, and you're seeing loan growth pick up. That's good, right?
Yeah, the lowest point consumer deposits was in August, I think. And all deposits have been growing since May of 23. So and again, we went in the pandemic with 1.4 trillion deposits, came out with 1.96 last quarter. That shows you the size of the economy, because that's a nominal number, not a relative. And loans are growing, and all that's because the United States is starting to see a more normal growth economy coming out. So consumer spending 4.5% in our customer base January so far over last January. The loan growth in the mid-single digits, the deposit growth, and a little bit better than the GDP growth rate. Those are all normal. Even though the economy is slowing down, you're seeing the normalization of the growth, as opposed to stimulus, a bunch of money moving around, a bunch of the rapid rise in rates. So you're seeing that normalize. That's a good thing. And I think that's good for the world, because at the end of the day, the size of the U.S. is important. Now, the U.S. has serious fiscal deficit issues to deal with. The U.S. has other issues, but overall, it's in pretty good shape. And when it's in good shape, that means the wonderful U.S. consumer is going to buy a lot of stuff, and that means it's going to help drive the world's economy, because the U.S. consumer segment economy is as big as China's economy.
Yeah. Courtenay, Elise is giving us the hard hug. So on the
I
back nine,
I can't see her, so.
we're on the Davos back nine. I always get a little sentimental, so I want to thank our hosts, Lightspeed, thank Bank of America, great friends of Axios, and Brian for a fascinating conversation, the Axios events team, and our Axios newsroom colleagues who have, in this whole week, produced such fascinating newsworthy conversations. Asia Whitaker-Moore, our editor-in-chief, is here. Courtenay Brown, and next to continue our big theme of healthcare and AI, the great Dan Primack.